$867 billion. That's how much the car industry is drowning in right now. You heard me. 867 billion. And just when we thought things couldn't get worse, they just did. This is the Car Gurus, and today we're peeling back a nightmare unfolding in real time. What started as a slow bleed is now a full-blown collapse. By the end of this video, you'll see exactly where we go from here, and why this could reshape your next car purchase, your wallet, and maybe your life. From the first breath, you sense something's deeply wrong. The camera, or your voice, lingers. 867 billion in unsold cars. That's a number going viral online, used in headlines, in memes.
It's shocking.
It's cinematic.
But is it true?
Yes, and it's just part of the story. Let me take you back. Over the past decade, car makers pushed harder, faster, expanding production, globalizing supply chains, chasing growth. Then came interest rates, supply chain snags, shifting consumer tastes, and a pivot toward electric vehicles.
The result? Overproduction meets collapse in demand.
In 2024 alone, automakers globally began reporting shrinking margins.
According to Reuters quoting the IMF, the shift to EVs will reshape everything: investment, jobs, trade flows.
That's not hype. That was the IMF's warning. So here's where it gets ugly. Dealership lots across America, Britain, China. They're filling up. Cars sit unsold for months. Inventory that used to turn over in weeks now lingers for 150, 200, 300 days. Dealers are discounting heavily, cutting prices just to move metal. Some trucks once marketed above $80,000 are being sold for $20,000 in clearance. The wreck is everywhere. And here's a twist. $867 billion doesn't refer to total debt or total industry losses. It refers to unsold inventory, vehicles produced but not sold. That's cars made, shipped, financed, but stuck in limbo.
This massive overhang is a choke on cash flow, credit lines, and investor confidence.
It's a ghost hanging over every automaker. Meanwhile, in the shadows, credit stress is creeping through the system. Auto loans in subprime segments are delinquent at historic levels, especially among low-income households.
Two recent collapses have sent alarms blaring. Tricolor, a subprime auto lender, filed for bankruptcy, leaving about 100,000 outstanding car loans unreconciled. Wall Street Journal covers how lenders are scrambling to sort the mess. And First Brands, a giant auto parts supplier, also went under, with misaccounted debt and a shadowy financial structure that's now collapsing.
Its liabilities spiked into the billions. Pause. Imagine this cascade: lenders seizing leased cars, suppliers unsupplied, factories shutting, workers laid off. It's dominoes in motion. At this point, you might ask, isn't this just a bubble bursting, something to ride out? Not quite.
Because now there's a dark turn, the big reveal. Behind the scenes, the collapse isn't random, it's systemic.
Many automakers and parts suppliers borrowed heavily, securitized receivables, pushed future cash flows forward, leveraged debt with minimal transparency. As margins narrow, one misstep can trigger insolvency. Take Germany, for example. Its auto sector is bleeding. Once the pride of industrial might, Germany faces deindustrialization across its car cities.
Volkswagen, BMW, Mercedes all saw profit drops in 2024 as costs rose, regulations tightened, and export demand flattened.
Meanwhile, German labor markets strained. The auto model that powered Europe is crumbling. In China, too, the pressure is palpable. Automakers have expanded aggressively, inventory ballooned. Some estimates suggest inventory across Chinese auto sector doubled in 2024 to over 370 billion yuan.
Debt surged, margins shrank to under 1% for many firms.
Reuters reported this shift in recent coverage. They're cutting prices, delaying payments to suppliers, and hoping for bailouts. And here's where things turn cinematic. Suppliers crippled, parts delayed, car lines idle. Imagine walking into a dealership to order a new car and being told, "We can't build it for you now." That's no longer hypothetical. Halfway through? Here's your moment. If you've made it this far, hit subscribe. You're going to want to see how this ends. Drop a comment. What's your worst car purchase story? I'll read those off in the next one. We lean back into the story. Let's look at how consumers got corralled into this mess. Rising interest rates over the last few years pushed monthly payments up. Inflation hit parts, labor, shipping. Many buyers ended up underwater. Negative equity, owing more on a car loan than the car is worth, became commonplace. Some reports say the average negative equity rose above $7,200. 1 in 5 car owners owes more than $10,000 extra. That's a pressure cooker. As defaults rise, lenders seize vehicles, flood the market, pushing used car prices down, driving deeper losses into new car pricing. It's a vicious spiral.
So what happens next? Some automakers will go bankrupt.
Some parts makers will fail. We'll see factory shutdowns. We'll see severe job losses in the supply chain. Governments might intervene. Bailouts, stimulus, tariffs, protectionism. We may even see consolidation. Mergers born out of necessity, not strategy. But here's the emotional twist. Why this matters to you. Maybe you're thinking of buying a car soon. Maybe you're financing one. Maybe you work in related industries. Or your city depends on car manufacturing jobs. This isn't a distant headline. This pressurizes credit markets, affects your loans, your job security, your city's tax base. In the final act, I want you to see the payoff. Inside the rubble, there's opportunity. Some automakers with strong balance sheets, clean debts, and electric pivot plans may survive, and even thrive. Companies like BYD, Tesla, or lean firms who avoided wild leverage might emerge winners.
In China, we already see some firms moving aggressively to consolidate and innovate.
In the US, the pressure is on Detroit, on suppliers, on unions, on policymakers. So the dark turn? It's this. We didn't just overbuild cars.
We overbuilt debt, overbuilt expectations, overbuilt leverage.
The infrastructure of the auto ecosystem is fracturing. The unsold cars, $867 billion worth, are the symptom, not the disease.
And as that disease spreads, the next curve could be a shock no one sees coming.
We close. The car gurus will be right here through that shock. If you're curious where the industry goes next, maybe the collapse becomes a reset, or maybe it becomes a collapse. You'll want to watch our next video. Rise of the Lean Automaker, Who Survives the Collapse? Click that next, hit subscribe if you haven't, and I'll see you in the next one.